Bom dia, tudo bem? Unfortunately, that's the extent of my Portuguese, so please bear with me as I give you a short presentation in English. Thank you. What I wanted to discuss today was take some of the concepts that Alex and Ian have been discussing today, but just give you a couple real-world examples of case studies of transactions that we've done in the past to highlight these topics. The first transaction is one that Alex just mentioned. It's called the Promenade at Sunset Walks. This was a $42 million deal that we actually closed just last week, so it's a very recent transaction. We did this deal at about a 4% spread, which is roughly equivalent to a 9.25% interest rate, and it was the most recent transaction that we closed in the Credit Opportunities Fund. The property was completed in 2019, so it's relatively new construction. And although it initially hit some issues leasing during COVID, as one would expect, the property was able to fully lease earlier this year. However, their construction loan was maturing, and due to the liquidity issues in the banking system that Alex and Ian have discussed, the lender wanted to get repaid, even though they actually lived with all the risk of building and leasing this property, and now the risk is effectively gone. The reason why they still needed a bridge loan is because to ultimately achieve permanent long-term financing, a property must exhibit cash flow for roughly at least 1 year for a bank or another type of permanent lender to finance it. And although the leasing has hit 100%, some of those tenants have taken occupancy more recently, so it needs to show that 1 year of cash flow. But again, as mentioned, the risk is significantly mitigated. And we love this transaction because of this in-place cash flow as well as the low loan-to-value. The property is very well located. This is Disney World. So it's at the entrance of Disney World in Orlando. And also this portion of Orlando where these two highways meet in southwest Orlando has become a major growth area with significant residential and commercial development. Finally, the sponsor on this transaction is a group called Encore Fund Management. They've developed over $4 billion of residential and commercial real estate throughout the United States and are an institutional sponsor. Just as an example of that, the property actually sits right here, but it's within this master development called Margaritaville. This project that the sponsor also built the entire project includes 2 hotels, 2 apartment buildings, hundreds of single-family homes, a condo project, a water park, and a timeshare, which they're currently building today. The reason why we wanted to highlight this deal is because of the difference that this transaction shows between what we call the market peak, approximately 1 to 1.5 years ago, versus today. So a year ago, this project would have been underwritten with a 5.5% cap rate, resulting in approximately $95 million value. The market was routinely financing such assets at a 65% loan-to-value ratio. So a lender a year ago would have lent approximately $60 to $65 million on this asset. Today, our appraisal used a 6.5 cap approximately, so about 100 to 115 basis point increase to account for the increased cost of debt, and valued this asset at only $80 million. Furthermore, due to the lack of competition in the market today, as opposed to lending at 65% LTV, we were able to negotiate a transaction which was just above 50%. So we lent $42 million. But what additional measures is BridgeInvest implementing today to account for the additional risk in the market? Firstly, we're underwriting additional vacancy to account for potential tenant credit issues. So as opposed to a $5.3 million NOI, we underwrote a $5 million NOI, approximately a 5% increase. Secondly, valuations are becoming increasingly unclear. So as opposed to using a fixed cap rate as such a specific analysis of value, we're focusing more on ranges of value. So although the appraisal underwrote $80 million, we were looking at a value of approximately $72 to $76 million. Now, nonetheless, we still believe that this is a safe loan as the LTV is below 60%. But lastly, I want to highlight one number on the screen, this 12%. This is the debt yield, which is effectively like a cap rate, except for loans. So basically, it's the property's cash flow divided by the loan amount. So this property, based upon existing leases, no projections, is generating a 12% return against our loan basis. So when we look at this transaction, maybe not everything will go well. Credit markets could worsen, equity markets could worsen. But we have a brand new asset in an excellent location that is generating a 12% yield against our loan. If this borrower defaults, we would ultimately be happy owning this asset. But let's dig in a little bit further. One of the important things that Alex mentioned earlier is that lenders a year ago were routinely structuring their loans based upon future cash flow projections, not current cash. So a lender that would have done this deal at $63 million last year would have actually financed an asset only making $2.4 million of NOI. That results in a sub 4% debt yield. So a lender in last year's market would have had 3 times less cash flow supporting their loan than we have today. And the last point that I'd like to make is on valuation and exposure. So once again, if you did that $63 million loan last year, then what is that LTV today? Well, we think the value is roughly $75 million, let's say, which would generate an 85% loan to value. That is a level at which there is no credit market in today's world that will take out this loan or take out the loan that someone would have done a year ago. So either they need to sell or they need to hold on for long enough for credit markets to recover and possibly valuations to increase. I think this is a really unique and real-world example of what's going on for lenders in the United States today. This project went very well. The sponsor built it, they leased it, the rents are strong, and everything was executed appropriately. But yet, a lender who lent on this project a year ago would be facing a situation where they only have a 15% margin of their loan versus the value of the project. Imagine if this project was not successful. What are those lenders doing and what are their credit issues look like today? The second example I wanted to go through was the Variety Hotel. This was a loan that we closed in March of 2019, collateralized by a hotel in South Beach. The property was actually originally built at the turn of the century, later converted to apartments, and our sponsor was doing a full renovation to convert it back to hotel. We lent $21.5 million at roughly a 9% coupon. And the sponsor in this transaction was 2 individuals who were backed by a number of wealthy New York-based families. As always, we focus on location, and this asset was in South Beach, Miami, one of the top hotel markets in the country, arguably today the best. And it's located at the end of Lincoln Road. For those of you that are familiar, it's an extremely popular pedestrian walkway, and roughly a 10 to 15-minute walk from the beach. This location was well suited for the sponsor's business plan, which was to offer more of a budget-conscious hotel for younger travelers. When the borrower first began this project, they actually financed the transaction with a bank loan at a 5% interest rate, total, not spread. But after buying the asset for $20 million, investing $20 million into renovations, they ran into cost overruns. With many of these projects, when you're ripping up old properties, you find surprises behind the walls. So their costs increased by 20%, and their bank was unwilling to finance these cost overruns. So the borrower was in a tough position and needed two things. First of all, they needed a lender that can move with speed, because they were at risk of not making payments to their general contractor. And this is a tremendous risk for a project. If you don't pay your contractor, the immediate concern is that there are delays. However, that's actually the best case scenario. Because what actually can happen, and often does, is the contractor stops working on the project, terminates their agreement, and then to get them back on the project, you would be paying an additional 20% extra cost, if not more. So the borrower needed someone to move fast. Secondly, they needed a lender who could do this deal. Underwriting and structuring a loan in the middle of construction is very difficult. Although there are issues in the credit market today, if you have a fully cash flowing asset, there is a lender who would be willing to do a deal. There are less lenders who can finance construction, and I don't think there are even 10 lenders in the entire United States who would be comfortable financing an asset mid-construction. However, since we have a sophisticated servicing team who has managed construction during special servicing, we believed, and rightfully so, that we would be able to underwrite this transaction. Let me just take a quick aside and talk about our valuation and due diligence process a little bit. The first thing for any good analysis before you start, no matter how sophisticated your analysis may be, is good research. The assumptions that drive your analysis is what make the difference. We use proprietary data sources as well as subscriptions to various data sources to make sure that we have good information. We conduct our own rent surveys and expense surveys, often pretending to be renters to try to get the most accurate information of what's really happening at the projects or at the competitive projects. Every property we close, every loan we close, the property is toured by one of BridgeInvest partners. And here's the real differentiator where we go the extra mile. For every transaction that we do, we will not close the transaction unless we interview local owners, managers, brokers, but individuals who are involved with the asset at the market level. It's not enough just to get data. You need the color commentary from people that are operating these assets. With that information, we focus on 3 technical analyses. The direct capitalization approach, where we recreate, if it's a pro forma, or review existing cash flows, and then use a cap rate to determine the asset's value. The discounted cash flow approach is very similar, but we look at cash flows over time and use an appropriate discount rate to figure out today's value for the asset. And lastly, we look at a takeout approach. What this approach analyzes is not the asset value, but the availability of credit at the end of the transaction to take us out, to satisfy our loan as a potential exit. For this analysis, we look at key credit metrics such as loan to value, the debt yield, which I mentioned earlier, and the debt service coverage ratio to evaluate a potential takeout of the loan. And lastly, we look at a sales comparison approach. This approach takes all the technical analysis that we do, but also evaluates what market participants are doing when they're buying similar assets in similar locations. One of the first things that I always look at in any appraisal approach is the sales comps. And a key tell sign that it's a bad appraisal is when they use other sales in Sao Paulo to tell you what the value of an asset in Rio is. That never works. You need similar comps. Finally, every deal we do is analyzed by an independent third-party appraisal, And again, as a step where we take the extra mile to make sure that the analysis that we're doing is correct, is we have an internal appraiser who reviews and confirms that every appraisal done by the independent third party is correct and accurate. In terms of due diligence, this is another point where I think BridgeInvest really differentiates itself and we take pride in. What you're looking at on the screen is actually a screenshot of a cloud-based software called Asana that we use as a project management tool. For every transaction, we look at over 200 points of due diligence to make sure that we are appropriately structuring the loan and not making mistakes. This tool allows us to communicate instantaneously, share information both among our origination team, but also through asset management. And throughout this entire process, we always work with the top lawyers from the biggest law firms to make sure that we're doing things correctly. So for variety, what happened when we concluded this due diligence process? We initially actually signed a letter of intent for about $25 million. But we were a little bit concerned with the valuation, and we were a little bit concerned with the borrower's ability to execute the project at the end of the day. So we took our $25 million loan and we separated it into a senior loan and a junior loan of $3.5 million. The junior loan was fully subordinated to us, so any principal or interest due to that loan would have only come after payment of BridgeInvest. We found a counterparty to buy this junior loan who was not only able to simply invest the $3.5 million, but the counterparty was a hotel operator on South Beach. So if things went wrong, this operator could also add value to the project by hopefully managing through issues. And at first, things were great. One could say to the bone. But as you remember, the first thing I said about this transaction is that we closed in March of 2019. This means that the hotel was opening around March of 2020. Not a good time to be opening a hotel anywhere in the world. Eventually, the borrower could not generate the cash flow to pay the loan, and they went into default. So what happened? Well, we had to foreclose, and as Alex mentioned, it took longer than we wanted. When the borrower first went into default, courts in the US were actually closed, so we could not actually begin the foreclosure. Eventually, courts reopened, and we used a very important legal provision in our loan documents to apply pressure on the borrower to not contest our foreclosure. Out of this $19 million of equity that you see here, the borrower invested, only $2 million were invested by the two individuals actually running the project. The other $17 million was limited partners in the deal. Our documents call for the ability of BridgeInvest to sue those general partners for the full amount of our loan, $21 million, if they contest the foreclosure. For the guys who only put in two, they didn't want to risk their net worth for the other investors. So they gave us the keys. The property went into foreclosure, and we executed and took over the asset. So the first thing I want to highlight is in a transaction where things go wrong, the borrower group, the partners, lost $19 million before we had the risk of losing 1 cent. Now, what else did we do to mitigate the risk? Let's talk about this junior loan for a second. During this year-plus time that we were going through the foreclosure process, there was $3 million of interest which accrued under our loan. It's this green box. And there was an additional $4 million of unpaid default interest, which accrued under both tranches, and that's the top gray box. Once again, it was creative legal structuring that mitigated the risk of this transaction. The documents for the junior loan, vis-a-vis our investment, the intercreditor, mandated that within 90 days, 3 months of foreclosure, the junior lender had to fully pay us off or they lost their entire investment. It was wiped out. So within those 90 days, the junior lender not only repaid our $21.5 million of principal, but they also repaid our $3 million of unpaid interest to make us whole without losing anything on this transaction. Last but not least, I just wanted to highlight a few things about the Fund 4 portfolio. To date, we have already closed about $180 million of transactions and have another roughly $100 million under LOI, meaning we're closing hopefully in the next couple months. In total, we have invested, or we will invest, nearly $300 million in Fund 4 across these assets that you see here. The average LTV of this portfolio is 57%, and the average interest rate before any other fees, which you all share in, is 11.75%. It's a well-diversified pool with investments in 8 different markets across 5 different states, and the asset allocation has shifted in the sense that 2/3 of this portfolio are either in multifamily or industrial, which are asset classes that we had trouble being able to generate business in prior. The other thing that you don't see on this page is the credit quality. The sponsors across this portfolio have significant more experience and more net worth compared to borrowers that we've dealt with in the past. As Alex mentioned, one of the assets that we hope to close in the next couple weeks is with Related Group. For those of you who don't know Related, they're one of the largest developers in the United States and certainly the largest in Miami. I'll be honest with you, I've been calling Related for 10 years. They have never answered my phone call until last year. This is what's changing in the market. So just to finish, I'm actually going to celebrate my 10-year anniversary with BridgeInvest in a few weeks. Although when I started, the industry was less mature and we were able to generate quite high yields, when you look at the market dynamic today, you have a unique opportunity where you have transparency into a pool of $300 million of assets where the returns are fairly similar to what we were able to generate 10 years ago, but the credit quality of the transactions is extremely superior. I thank you all for your time. Pardon my English. I'll try my best next year in Portuguese. Thank you.